Okay, so in this video, I'm going to be talking about a trading model that you can use. It's a very simple trading model. There's not a lot of moving parts to it that you can use to get funded. This one model right here is all you need. It's all you need. Like, it is so simple and it's so effective when done right. It's very similar to my personal trading model, which I have, which I'll actually link that video in the description of this video, my personal trading model. It's similar to that, but there's a few different tweaks to it that you can use, because with my personal trading model, if you remember what I need, and this play actually has that criteria, but you don't absolutely need to do it. But for my personal trading model, I like to see the daily market structure 100% confirmed, putting in like consistent higher lows and making consistent highs. So here's what you're going to do. Your main higher time frame chart is going to be the 4-hour chart. The 4 hour is going to be your higher time frame chart. Okay. And the 4-hour chart is where you're going to identify your key higher time frame levels, your key higher time frame level points of interest. Okay, you need a higher time frame level. That's key, and it needs to be operating within a bullish market, or you need to be trading with the market structure on the 4-hour chart. So with this example on USD/JPY right here, see how we're consistently putting in higher lows, higher low, higher low, higher low, higher low. We're consistently putting in higher lows, which means it's operating within a bullish market structure. For any of you that don't quite understand market structure, what I'm going to do is I'm going to leave, because I have an entire playlist on market structure, and I'm going to leave a link to that in the video description. There's going to be my entire playlist on market structure. So if you don't understand that, you can watch that after this video. Okay. But so like in this case with USD/JPY, the market structure is 100% bullish and it's consistently putting in higher lows. Okay. And now we need a higher time frame point of interest. We need to see price pull back into a higher time frame point of interest. What can those higher time frame points of interest be? And what does that mean? What I do is I use old highs, old lows, depending on whether I'm buying or I'm shorting. Or you can use order blocks, like bullish order blocks, bearish order blocks. And I don't use breaker blocks really, but you can use breaker blocks if you want as well. I'm sure if you just go in and test it, you'd have good results with those as well. Yep, so that's what you want to see. So you see right here on USD/JPY. Say we have an old high right here. This is an old high, and it's also in a discount marketplace. So what I'm going to do is I'm going to mark this old high level right here. See that? Highs high in the middle, 2 lower highs on the left and the right. That makes it an old swing high level. And that swing high that gets broken, it's now support, and it's in a discount marketplace. That's key. You need it in a discount marketplace as well. If you're buying, if it's in a bullish scenario and you're buying, you're looking for buys, you need to see that old high in a discount marketplace. So take your Fibonacci from this low to that high of wherever price the top of the rally is. And you can see how this old high right here is below 50% equilibrium of that price range. That means it's in a discount marketplace. This is a 4-hour price range right here. We take the low to the high and we measure that price range. We find 50%. This old high is in a discount marketplace. That means it's a valid level of support because it's in what's considered a cheap marketplace based on the 4-hour price range. We also got 4-hour sell stops right here as well. So we take out that, we'd be in a discount too. So that's what you want. At this point, we've identified our higher time frame point of interest being this old high right here. Okay. Now what do we want to see next? We want to see a pullback. We want to see a pullback into that point of interest. Boom, right there. See how it stabs down into that level? It cleans out these sell stops and it trades down into that old high support. Remember, the higher time frame market structure is bullish. You want to be trading with that trend. You want to be trading with that higher time frame trend. Okay. And you also had a bullish imbalance in here. This isn't 100% required, but it's a nice bonus. See how we're tapping down into a bullish imbalance as well. That's serving as support. So we're testing old high support and a discount. We're tapping down to a bullish imbalance. We got this stop run. That's all we need to do on the 4-hour chart. And this is our draw on liquidity. Because remember, you're playing the 4-hour market structure here. This is your draw on liquidity right here. See this old high on the 4-hour chart? That's your draw on liquidity. You want to see that left untapped. You don't want to see price come up and take this out right away. And I'm going to expand on that in a bit more here in a moment, what I mean by that. But just know that this is your draw on liquidity. And right now you want to see this left untapped. Okay. Now what we're going to do next, after we get that test of a higher time frame level of support, we want to go down to a lower time frame chart. Your lower time frame chart can be either it can be your 1 hour or your 15 minute. All right. So my advice, just stick with the 1 hour. That's all you need is the 1 hour for a lower time frame chart. So basically with this strategy, your higher time frame chart is going to be your 4 hour, and your lower time frame chart is going to be your 1 hour. Like the 1 hour chart is going to be your execution time frame. That's where you're going to look for your confirmation signal. And we're going to go into what that confirmation signal is. Okay, so we can see we're having a reaction off of that higher time frame old high support right here in the discount on the 4 hour range, and we're testing a bullish fair value gap. Now what you want to see next is a shift in market structure on the lower time frame. And this is very important. You want to have that shift in market structure, and you want to see this high right here left untapped. You don't want to see it take out that high. If it takes out that high, it disqualifies the play. You don't want to mess with it anymore at that point. Let me say that again, because this is a very important component. You want to see that shift, but it needs to be on a short-term high that's below this high. This is your draw on liquidity, and you want to see that left untapped. You want to see that left untapped, and that's actually going to be your profit target too. Because remember, you can shoot for that profit target because the 4 hour market structure is bullish. It's operating within a bullish market structure. So that is a valid PT. You can shoot for that. And you have let price trade down into a discount as well. So it already traded down into an area where it's considered cheap based on the 4 hour price range. So now it's ready for that move up higher to take out that high at this point because it's pulled back enough. All right, so now we're seeing this move. Now we want to see a shift in market structure. Let's see if we get it. Do we got it yet? We don't got it yet. We're still waiting on it. We're still waiting on it. Still waiting on it. Right here. See this? What is this? This is a swing high level. Highs high in the middle, 2 lower highs on the left and the right. See how we got this swing high right here on this 1 hour chart. And also notice at the time that we took out this swing high right here, this high right here is left untapped. This high right here has been left untapped. That is untapped liquidity. And we still have that draw. That is our draw at the moment. And now we got a shift in market structure on the 1 hour chart while leaving that untapped because we took out this swing high right here. Now this is very important. This is another key thing you want to note. On the shift in market structure, you want to see a fair value gap left. So you look right here. See that? There's your fair value gap right there. 3 candles make the fair value gap, remember. Look at my cursor. 1, 2, 3. The top of the first candle and the bottom of the third candle do not touch, leaving nothing but body in between that. That is a gap. That is the gap between this candle and that candle, leaving nothing but body. That makes it a fair value gap. Think of it like price did not have a fair shot of being efficiently delivered. It's an imbalance. And you want to see that imbalance created on the shift, which we saw right here, cracking this high. So we have this fair value gap. We got the shift. It cracks this high. It's off of we get this reaction off of a higher time frame point of interest, being that old high. And we still have this draw on liquidity up above, serving as a draw. Now, what do we want to see next? Well, now we want to see a pullback into a discount marketplace. You want to see a pullback into a discount marketplace. That's next. How do we know when it's pulled back into a discount? Well, what you do is you draw your Fibonacci from the low of the impulse move to the high of the impulse move, meaning just that shift. So this was where we absolutely found our low after pulling back into a discount and having that reaction. And we're going to take our Fibonacci from that low to that high. If it does end up ramping up here a little bit more, then you'll just have to adjust your Fibonacci with it. But now you want to see it pull back into a discount. And the second it pulls back into a discount, it's considered cheap. But here's the deal. With this strategy, there's nothing wrong with that. You can enter on a discount, but I know a lot of traders, because me personally, I love entering like right at a discount. That's me personally, but what fits me isn't what fits everybody else. Like there's not like one style fits all. I know a lot of traders, they like having bigger wins and losses, a lot bigger wins and losses, like 2-to-1 risk reward, for example. So that's what I'm kind of tailoring this strategy to. If you don't mind like 1-to-1, then by all means, you can enter in a discount. But here's a way that you can consistently with this strategy, milk off around 2-to-1 on average. Sometimes it might be a little bit less than 2-to-1, but on average, you'll get about 2-to-1 risk reward on this play. Actually, over 2-to-1 risk reward on this play. And with that risk reward ratio, you can be correct less than 50% of the time and absolutely kill it. Absolutely kill it. Let that sink in, less than 50% of the time. So now what we want to see is we want to see a pullback into optimal trade entry. What is that? Optimal trade entry is 62% retracement on the Fibonacci. So you can see right here, I have these optimal trade entry settings put on now. Here's 62%. Look at my cursor. See that? That's 62%. And see how it pulls back? It rebalances that price action right there. and then it pulls back into optimal trade entry at 62%. That is your entry with this strategy. Right there, 62%. Every single time it's the same. There's no scratch in your head. It's just so simple. And you know exactly where to enter. You know exactly where to exit. You know exactly where to keep your stop. It's so freaking simple. You enter at 62%. Where's your stop going to be? Your stop is going to be underneath the low of the impulse leg. If it's a shorting scenario, well, then it's going to be on top of the impulse leg. It's that simple, guys. Oh, let me put that back on there. So we're going to enter right there at 62%. You're going to have your limit order set right there, and you're going to get in. Your stop is going to be underneath that low. And what your profit target, again, you can play around with this, do what fits you best. If you want to take profits right there, there's nothing inherently wrong with that. Absolutely not. But I know a lot of you like bigger risk reward plays. It fits you. It's easier on your psychology. I understand. So if you want to do that, well, then you would shoot for this high up here. And that's a valid PT, guys. That is a valid PT. That's previous day's highs. Okay. Well, actually, it's highs from a couple of days ago, but that's a valid PT because that's our draw on liquidity. That's the high of that 4-hour price range. Because don't forget, the 4-hour market structure is still bullish. You're trading with that higher time frame 4-hour trend, and the lower time frame chart is your 1 hour. And you're looking for that 1 hour shift while operating within a bullish market structure on the 4 hour. So you have this multi-time frame alignment in there. And then on this 1 hour, you get that shift in market structure. So you're going to shoot for this high right here. That's always going to be your PT. And remember, you never want to see it come up and take that 4-hour high right here. You want to see that left untapped. You want to see the shift in market structure on the lower time frame chart, which we got right here where it cracked that high. But you want to see that left untapped because that's going to be your PT. You want that draw on liquidity left. It makes a very big difference, a huge difference. So you're going to get in right there at optimal trade entry. Let's see what that would be on the risk reward. So you get in right there, right smack on 62% retracement. Your stop is always going to be underneath of that impulse leg. And your profit target is always going to be the high of that 4-hour range. Look at that. 2.41. That's over 2-to-1 risk reward on that play. So once you average it off, you'll hit an average of around 2-to-1, a little bit over 2-to-1 risk reward consistently trading like this. So you can be right less than 50% of the time and kill it. That's a great risk reward. That's awesome risk reward. So that's what you're going to do. And now this actually set up during London kill zone, but it doesn't matter what time you trade. You can use this strategy during New York kill zone. You can use it during London kill zone. Like, just do whatever fits you based on where you live, etc. So at this point, you're into play and you're letting it work. Now you're just going to let the play ride. See, it's gyrating up, it's moving up, and boom, we pierce that high. You take profits as soon as it pierces that high. Right there. That's your trade. That is your trade. It's that simple. It's that easy. That's the signature you look for every single time. All right. Again, let's just one more time. Let's break it down. The 4-hour chart. This is a bullish scenario, but then everything I just talked about, you'll just flip around for a bearish scenario. It's like the exact opposite. Okay. You're still looking for, you're confirming the higher time frame trend. You're still looking for higher time frame levels. You still want to see that draw left. You still want to see that old high or that old low left untapped. And you still want to see a lower time frame shift in market structure. You still want optimal trade entry. It's the same exact thing. You just flip it around. Okay. So there was our move. So we confirmed that the 4-hour chart was bullish. We pulled back into a 4-hour discount. We take our Fibonacci from that low to that high. We measure that price range. I got optimal trade entry settings on, but it pulled back into a discount. And it tested this old high right here in a discount. That's your higher time frame point of interest. And now you want to see a lower time frame reaction while leaving this high left untapped. That's when you go to your 1 hour. You get your 1 hour shift right here, cracks that high. It leaves your fair value gap confirmation. And you can see on this move lower right here, it also sweeps this lower liquidity. So you get your liquidity grab, you get your shift in market structure. And now you want to see a pullback into optimal trade entry, which is 62%. You're going to get on board 62% retracement. You're going to keep your stop beneath that point, and you're going to target that high right there. Okay. Again, you can play around with this and kind of add your own twist to it if you want, but I'm giving you a very simple model, a very simple system to follow that's going to consistently give you on average about 2-to-1 risk reward. It's a working system. That's a working system right there. Right there. I laid it right there in front of you. You can take partials if you want. You can take profits that high, but this is a way that you can do it. So let's actually go look at another play real briefly here. All right, so this was another play from the other day. This is NCD USD. So the 4-hour market structure on NCD USD is bearish. So now we're using a bearish scenario because we used a bullish scenario before. Now we're using a bearish scenario just to show you that it's basically just the reverse. So your higher time frame level, it can also be a higher time frame liquidity pool, like an old high or no low. All right. So in this scenario, since it's a bearish scenario, you want to see it like we take out a higher time frame liquidity pool. Okay. So I want you to notice how we got higher time frame 4-hour buy stops right here. See how we got buy stops right here? See these equal highs? See this swing high level right here? That's a higher time frame liquidity pool in the 4-hour chart. And the market structure is bearish, as you can see. It's operating within a bearish market structure. So we want to be trading with that higher time frame trend. And you can see what happened right here. What just occurred? At this very moment, what just occurred? We came up and we took higher time frame buy stops on the 4-hour chart, aka your higher time frame level. See how we came up and we took these buy stops? That's your liquidity purge. Now, what do we want to see next? For the rules that I just gave you, I want you to answer among yourselves real quick. We've pulled back into this higher time frame point of interest. We're taking out these highs, which means it is in a premium marketplace. What do we want to see next, though? Well, we want to see a lower time frame shift after doing so. And you also want to see on that shift, remember, you want to see this low left untapped because we're playing that 4-hour market structure. The 4-hour market structure is bearish. So we're basically playing that trend and we're just utilizing the 1-hour chart to get on board, to time it better, to minimize our risk and to capitalize on that move lower. So now let's go down to a 1-hour chart and let's see what happens. So you can see this is where we got that push up. Now we're coming into London session at this point and we get a Judas swing. See how you get this pop up right here and we get another push up higher. We cleaned out these highs actually in Asian session, but then we get a second push up, cleaning out this 1-hour buy stops in London session. So you clean out that as well. See that? How you got this old high right here that you cleaned that out during London session, which is prime time for your Judas swing to occur. So you get your Judas swing. You clean out those upper buy stops. Remember, you want to see that shift, but you also want to see this low left untapped. That is your draw, and you want to see that left as your draw. And that's also going to be your profit target. This low right here is going to be your profit target. So next you want to see a shift. Look at that. Right there is your shift. See how we came down and we cracked this short-term low? Right there. Lowest low in the middle, 2 higher lows on the left and the right. That is a shift in market structure. Now, how do you know it's a shift in market structure and not a stop run? Well, you use your fair value gap confirmation. That'll keep you out of a lot of stop runs. Right there. And remember, you're also taking higher time frame liquidity or you're rejecting off of a higher time frame point of interest. And now you have this 1-hour bearish fair value gap confirmation. You need that fair value gap on the shift. It's very important. So we come up, we take liquidity, we have a shift, and we still have this drawdown here that's left. Now, what's next? Now that we have confirmed we've had a rejection off a higher time frame point of interest, we have our shift in market structure, we have this draw left. What is next? Well, next we need to get an entry. And where do we get an entry on this? Since it's a bearish scenario. For a bearish scenario, you want to be entering in a premium marketplace. Or my mistake. You want to be entering in optimal trade entry. An optimal trade entry will be in a premium. All right. So what you're going to do next is you're going to drag your Fibonacci on from the high of that displacement to the low, and you're going to measure that price range. And see how. So here is optimal trade entry. Right there, look at my cursor, look where it's moving. There's optimal trade entry. There's 62% on the retracement. So it's like very mechanical. You're just going to set your limit order right here at 62% now. And you're going to wait. You're just going to set your limit order because you know exactly where you're entering. It takes the thinking out of the equation. It's very systematic. And then you're going to keep your stop above the displacement high right here where that liquidity run occurred. And your profit target is going to be that low right there. It's always the same thing. It's always the exact same thing. It removes the thinking, and it's such an easy system to execute on because there's not a lot of moving parts to it. It's extremely simple. It's great risk reward, and it's highly effective. So you're going to shoot for this low. Now we need a retracement. Let's see if we get it. We still haven't taken out that low, and we're going to see it left untapped. Remember, right there, boom, 62% on this move up. See that? We come up into 62% retracement. You'd be entering right there. Right there is where you'd be entering. Now you're going to look for a move down into this low. Now you're just letting it ride at this point. Gets a little bit of a deeper retracement. You're still in it though, because it hasn't tagged that high. You're still in the play. And you're just going to let it ride. It comes down. It comes down some more. Cleans out that low. You take profits once it cleans out that low. That's the trade. What would risk reward would be on this? Let's just see. So you got in, remember, you got in at 62%. Your stop is going to be above that high. Nope. Yep, right there. Your stop's going to be above that high. Your profit target is going to be that low. 2.24, over 2 to 1 risk reward again. So your average across the board is going to be about 2 to 1, a little bit over 2 to 1 risk reward on this play. And that's the criteria. That's what you're looking for every single time. It's very similar to my personal trading model again, but I'm not saying you got to look through as many pairs as I do to find that daily trend. That's what I like to do because I like just to have everything lined up. But you don't absolutely need to do it like that. You could just utilize the 4-hour chart as your main higher time frame chart. And like you need at least, I recommend at least 2, like a higher time frame chart, 1 higher time frame chart, and at least 1 lower time frame chart. So in this strategy, I gave you that. The higher time frame chart is going to be the 4-hour chart, and you're looking for bearish market structure. And on the lower time frame chart, that's your 1-hour chart. You're looking for your shift. You're looking for your fair value gap confirmation, and you want to see that low left untapped. It's going to be the same thing. Like it's the same profit target every time. It's going to be that untapped liquidity, and your stop's going to be the same thing every time. It's either to be the high of the displacement leg if you're shorting, or the low of the displacement leg whenever you're buying. Entry is optimal trade entry, 62% on the retracement every single time. It's so simple. It's such an easy system to follow because there's not a lot of moving parts to it, but it's very effective. You can get funded with this. You could build a career with this one strategy that I just gave you. So if you enjoyed this video, make sure you leave a like, you subscribe to the channel. I'll catch you later.